Hey, Bridget, it's good to see you. I want to talk about the recent market sell-off and volatility. The S&P recently booked its seventh consecutive weekly decline, marking only the fourth time in history that had happened. And the Dow Jones was in the eighth consecutive down week. The last time we saw that was back in 1932 during the Great Depression. And if that weren't enough, I want to show you this chart from FinViz, which shows the S&P for the past month. There's a lot of green, a lot of red, but when I see these big cap stocks or so much color all over, what am I supposed to do?
Well, you see a lot of green on there as well, which is
Hmm.
good. That means that there's some optimism in the market as well. There's a lot of volatility, and understandably, there's a lot of concern right now. But people have to remember too, with all the statistics that you quoted, historically, downturns of greater than 10% happen just about every other year. As a matter of fact, it's happened 24 times since 1980.
Hmm.
So there's a lot going on in the world. Some things are unprecedented, but the volatility is something that we've always had to live with.
Hmm. But that being said, you as the financial expert have planned for this, right? You design these portfolios to weather these periods of volatility.
Correct. Yeah, especially for our clients because our clients are retired or retiring soon.
Hmm.
So at Riley Higgins, we make sure that they have a stable foundation. So regardless of what the market's doing, they know that they can sleep well at night. As a matter of fact, our passion here at Riley Higgins is ensuring our clients think more about their lives and less about their money.
Yes, I like that. That is always a good philosophy to live by. Now, I want to talk about behavioral finance. You've studied data from 30 years, right? You know
Mhm.
that during market volatility, people tend to panic and sell precisely when they shouldn't. What am I looking at here?
You're looking at emotion, and we need to keep
Yeah.
emotion out of the equation because the knee jerk reaction is to when fear comes, then you want to sell and you want to get out to a safe place. That's counterintuitive on a very
Yeah.
high level.
Right.
So if you just hold on, it's all gonna balance back out.
All right. Something else that I found really helpful to kind of illustrate that point, Brookstone Capital Management CIO Mark Diorio supplied us with this graph. He essentially shows us a $10,000 investment over a 15-year period. And if you just miss the 10 best days, if you're pulling money out, then you essentially have your profits because those good and bad days, Bridget, they're like smushed right up against each other.
Exactly, exactly. And I love this chart that Mark put out because it does
Hmm.
illustrate for our clients very clearly that just to take your time and not knee jerk into any bad decisions that might be bad in the long run.
Right, really good point. So there are some experts, though, who are advising investors to be defensive. What does it mean to be defensive as an investor?
Well, defensive means keeping an eye on it, obviously, and maybe moving into places that are seeing a little bit more of a positive return than some others. For example, we offer alternative investments to our clients, such as buffered ETFs and structured notes. We also are moving a lot to the value stocks right now, which are not taking as big of a hit as some of the other companies are.
Good point. Well, it was really helpful to talk this through. If somebody watching this video has any questions or they want to learn more about those advanced investment opportunities, what's the best way to reach you?
Go to our website, www.rileyhiggins.net, and you can check on the contact box in there, or you can call us directly at 480-581-8545.
Very easy. All right, Bridget, thank you.
All right. Thanks, Erin. Great to see you.